Great. Well, good morning, everyone. Thank you for your patience with us just there. So my name's Hannah Sanders, and on behalf of the Spanish Chamber of Commerce in the UK, we'd just like to say a warm welcome to this morning's webinar, which is on the topic of navigating VAT complexity, which we are delighted to be holding in partnership with Solvus Accordance, who are benefactor members of our chamber. For those of you who aren't yet familiar with the work of Solvus Accordance, they're a team of experts in VAT who combine their consulting experience, their rigor in regulatory compliance, and solid relationship management to help their clients recover their VAT. So today we're joined by Andy Spencer, who is a Director of Professional Services at Solvus Accordance, holding responsibility for the consulting and compliance teams. Having joined Solvus Accordance in 2009, Andy is a highly experienced indirect tax professional who has worked in VAT for over 32 years and in companies including HM Customs and Excise, KPMG and Ernst & Young. If you'd like to ask a question to Andy, you can do so by using the Zoom tools that you can see at the bottom of your screen. So there's either the chat or the Q&A functions. Feel free to write in your questions as you think about them, so throughout the presentation, but bear in mind that Andy will be answering some of these following his presentation in the Q&A part, but please ensure that you include your full name when you write in so that Solvus Accordance can get in touch to answer any questions that we run out of time to answer during the Q&A. I'd just like to let you all know as well that following the webinar, Accordance VAT will share the presentation with you all, so you will have that after. Perfect. Well, now without further ado, Andy, I'll hand over to you.
That's great. Thanks so much indeed, Hannah. Good morning, everyone. So today we're going to talk about VAT in 2020, navigating VAT complexity. So if we move on to the agenda, so we're going to talk about a very topical subject, which is Brexit. So we're going to look at where we are now, importing goods into the UK and implications for business. We'll then move on to the e-commerce package, which is a number of changes which are going to be made next July. They were originally intended for the 1st of January, but they've been delayed. We'll then finish with the 4 quick fixes, which were implemented earlier this year, which have an impact on how businesses that trade across the EU have to deal with a number of key areas. We'll then talk a little bit about how we can help you, the type of services that we provide, and as Hannah said, at the end we'll have a Q&A session, so if you've got any questions, please feel free to raise them as we go through. So that's a little bit about myself. I'm also joined by my colleague Sonia, who's our Enterprise Account Executive with Solvus Accordance, and she'll be able to support you going forwards with any questions that you've got. So if we start with Brexit, where are we now? So Brexit seems to be something that we've been talking about, well, we have been talking about it for the last 4.5 years. It's finally come into the end game. So rather than looking at the whole last 4.5 years, we've just looked at what's happened in 2020. So as I'm sure you're all aware, the UK formally left the EU on the 31st of January 2020. So it's no longer a member state, but it immediately went into a transition period, which is going to last until the end of December 2020. There was the opportunity to extend that transition period. The formal legal deadline for that was the 30th of June, but the UK government announced on the 12th of June that it wasn't going to extend, so the formal deadline has now passed. The consequence of the transition period is that until the end of 2020, things pretty much stay the same as they were last year. So the UK remains in the single market, remains in the customs union, and VAT rules apply as they did previously. As I'm sure you're all aware, the UK at the moment is trying to enter into a comprehensive free trade agreement with the EU, and that's been a lot of difficulties with those negotiations, but the good news is they are still continuing, but it's not clear exactly what's going to happen, whether there's going to be a comprehensive agreement, whether it's going to be more limited, or whether there's going to be an agreement at all. But the reality is that we do have certainty in that without an extension to the transition period, the UK will no longer be a member of the single market and the customs union as of 31st of December 2020. And with the COVID-19 situation and the lockdown, which started again in the UK this morning, it's not clear at the moment whether there will be an application for the further extension. My own view is it's probably unlikely, given the government's position in relation to leaving the EU, but it does remain possible, albeit that they would have to find an alternative route to the one that existed as of the 30th of June. But we don't know. We haven't got any clarity in relation to that, but we still need to plan regardless, and that's what we're going to talk about this morning. So if we move on to the consequence of what no deal means, so it's meant different things in different years. So it was in last year, before the UK finally left the EU, a no deal meant that there was going to be no transition deal. So it meant there was just going to be a hard Brexit and moving straight to World Trade Organization rules immediately. The deal meant that the status quo that we've just explained was maintained. So that's the current position. And in effect, nothing's really happened. So although the UK's left, there's been no change to date really for most businesses in relation to how VAT or customs duty works. In 2020, no deal is going to mean something different. It means that there's going to be no free trade agreement. If there is a deal, it means likely that the UK is not going to be in the single market or the customs union, because that's the UK government's stated position. They don't see leaving the EU as being in line with staying in either of those mechanisms. So the reality is in 2020, whether there's a deal or no deal, the UK is not going to be in the single market or the customs union. So there's going to be significant implications either way. And unlike in 2019, when a deal effectively saved the day, that's not going to happen this year. So businesses need to plan now and can't rely on that deal to resolve issues. So if we now look at importing goods into the UK, so the UK has published their border operating model. So there's been 2 versions so far, and that details what's going to happen in relation to goods that are going to be coming into the UK from the EU. So all goods from outside the UK will be imports. So currently anything that comes in from outside the EU is an import, whereas goods that arrive from the EU are acquisitions. So consequences of that is there's going to be a charge to VAT on import, and we'll talk more about that in a moment. There's also the potential for customs duty to apply, and that's why the UK is seeking to agree a free trade agreement with the EU. There's going to be a new UK global tariff, which will determine the rate of customs duty. That was published earlier in the year. You can look at what rate of customs duty is going to apply by using that link. And effectively, it sets out the different types of goods and then the rate of duty that will apply. So it's required because the UK used to apply the EU tariff, which is common to all member states, but given that the UK is not going to be within the EU anymore, it needs its own global tariff to determine customs duty rates. And those rates are the rates that will apply if there's no free trade agreement, or if there's no preferential treatment in relation to the country where the goods are coming from. So it's a big change, and that's the issue with VAT on import, is that it's recoverable. Customs duty isn't recoverable. So that's the potentially significant issue going forwards for businesses. The other impact is there's going to be a requirement for customs declarations. So one of the main benefits of the introduction of the single market and the customs union in 1993 was the removal of customs declarations for intra-EU movements of goods. So you had other obligations such as intrastat and EC sales list, but you didn't have to do a customs declaration. Now that the UK has left, it's going to require customs declarations. There has been a number of announcements over the past 2 years in relation to this. The current position is that the government accepts that there can be a delay in the submission of those full customs declarations for a period of up to 6 months. So that applies to imports prior to the 30th of June 2021. So if you import goods in that period from outside the UK, you don't need to submit a full customs declaration at that time. You still have to provide some information, but you don't have to have a full declaration. And that's really to recognise the fact that many businesses haven't had time or the clarity to prepare. And also there's an issue with the number of customs agents which are going to be available in order to deal with those declarations. So it does provide some relief for businesses, but there is going to be a need to do those customs declarations at some point, and after June, it's going to have to be done at the time of import. Any duty that's payable at the time the declaration is lodged can be deferred, so there's no need to pay it until the declaration is actually made. So if you import goods on the 1st of January, you're not going to have to pay any customs duty until you've actually lodged that declaration 6 months later. One of the key points is that you'll need a GB EORI number in order to be able to import goods. You'll also need that if you're going to export goods. Customs had a process last year where anybody that was trading with the EU, so they looked at boxes 8 and 9 on the UK VAT return, they issued a GB EORI number to all of those businesses. So if you're a GB business, potentially you've got an EORI number, but if you're going to import into the UK, you then need to have a GB EORI number in order to be able to do that. One of the things that the government has introduced is in relation to import VAT accounting. So this has gone through a number of different iterations. So it was originally proposed in 2019. And the way it works is that postponed accounting means that you don't have to pay the VAT at the time of import, and instead you can postpone it to the VAT return. The current government removed it in early 2020, but it was reintroduced again in the budget earlier this year. So the current position, and it's unlikely to change, is that import VAT accounting is going to be on a postponed basis from the 1st of January 2021. The good news is that it applies to all imports, not just from the EU. So if there's goods being imported into the UK from anywhere, they're going to be ability to be able to postpone that to the VAT return. There's no application required. You just account for the import VAT on the VAT return, and effectively that means it's the same as acquisition tax. There's going to be no new boxes on the return, and customs have confirmed that the way to account for it is to put the VAT due in box 1 of the VAT return with the VAT due on other sales, and then it's recoverable in box 4. There is going to be a monthly form which is provided by customs in order to show you how much VAT has been postponed. That will tell you how much is going to be payable on the VAT return. So it's a really welcome relief, which is going to help the cash flow of any businesses importing goods. The other thing which the border operating model confirms is the position in relation to Intra-EU. Now, Intra-EU is the mechanism which provides trade statistics for intra-EU trade. It was introduced because of the removal of the customs declarations that we've already mentioned. So you would expect, given that the UK is no longer going to be an EU member state, that Intra-EU wouldn't be required. But the border operating model confirmed that arrivals will still be required. And the logic behind that, from my perspective, is that if they're not going to get detailed customs declarations for imports, they need to get the information from another source. And the best way to do that is to continue to require businesses to submit arrivals declarations. So the way it works is if you currently submit, you have to continue to submit throughout 2021. But the good news, there is no requirement to submit dispatches, because if you're going to export from the UK, you need to continue to, or you need to start submitting full customs declarations, because the UK's got no ability to determine how other member states are going to deal with the requirement for declarations. So that's the position on Intra-EU, which is going to increase the burden for businesses, because they're going to have to do a customs declaration, albeit that it may be delayed, but they're also going to have to do Intra-EU as well. If we now look at the implications for businesses, so the key thing initially is to, if you haven't already, review all supply chains involving the UK and the EU. So understand what activities your business has involving the UK and the EU, and then look at the impact of Brexit on those transactions. So essentially, we're trying to establish whether the VAT treatment is being changed as a result of Brexit. but that will also include whether a previous simplification that's removed the need, for example, to be registered in the UK is no longer possible because of the change of the UK's status. The other thing which we'd recommend doing as well is looking at future supply chains in order to build a full picture, so you can future-proof your business to ensure that you understand the impact of Brexit in total on what you're doing regarding UK-EU trade. So once you've done that, you need to determine if there's any adverse implications. If there aren't, that's good news, and you can continue as normal. If there are adverse implications, you need to think about what you can do in order to restructure. You need to understand the consequences of that restructuring and whether it's viable from a commercial point of view, and whether it's acceptable from a compliance point of view. If it's not possible to restructure, you need to understand the consequences of that existing supply chain, determine the actions which are required in order to remain compliant, and then make sure that you take those required actions in good time. Now, as a business, Sovos Accordance see lots of issues where businesses trading within the EU involuntarily create issues for themselves because of the ability to move goods freely. So business can move goods from one country to another, create a compliance obligation from a VAT point of view in that other country, and it's not highlighted because those goods can initially move freely. The reality is that the customs border that's going to exist between the UK and the EU is going to prevent that involuntary non-compliance for goods. So if you're going to import goods into the UK and you're going to be the importer of records, you're not going to be able to just move those goods. They've got to go through some sort of control. So that's going to prevent that non-compliance. But ideally, what you want to do is ensure that you know your obligations in advance of moving goods, because if you don't, chances are the goods are going to get held up and there's going to be delays and disruption to the supply chain. If we now look at how goods are going to be impacted post-Brexit, so as I've mentioned, the concept of dispatches and acquisitions is going to go. That's removed for GB EU trade. And it's important there that I've mentioned GB rather than UK, because the position with Northern Ireland is more complicated. We'll talk briefly about that in a moment. So dispatches and acquisitions are now going to become exports and imports because the UK is a third country. So there's an exemption for export, which is similar to dispatches. So that is going to continue to be exempt. But you just need to make sure that you understand the conditions, what the evidence requirements are. But as I mentioned before, the big change is going to be in respect of imports. So they're going to be liable to import VAT and potentially customs duty. So any intra-EU supplies of goods are going to be unaffected by Brexit. So if goods are moving between Spain and France, the fact the UK is left has no impact at all, as you would expect. So I mentioned Northern Ireland. Northern Ireland is more complicated because of the Northern Ireland Protocol, which is the mechanism which has been put in place between the UK and the EU to make sure that the position of Northern Ireland is secure. Now, what that means is that Northern Ireland is still going to remain within the VAT area, is still going to remain within the customs union. So if there's trade between the EU and Northern Ireland, that's going to effectively still remain to be an EU transaction. If there's trade between the UK, between the GB, so England, Scotland and Wales and Northern Ireland, that's going to be a trade between an EU state, Northern Ireland, and a third country. So that's potentially going to be an import from, for example, the UK, import into the UK and then export from Northern Ireland. So Customs in the UK released some information last week in relation to how they see this taking place, and the reality is that they've said that they think they can continue to treat it in exactly the same way as they do at the moment. So the position at the moment is that the UK government has released relatively little in relation to trade with Northern Ireland. So if you are involved in that type of transaction, it's definitely something that you need to think about more. So there's another change which is going to happen with Brexit, is that in relation to low value goods. So we've got at the moment there's a low value consignment relief which applies throughout the EU. So the UK applies that in the same way as the EU, but it's got a lower limit of £15. That's going to be abolished. And the impact it has at the moment is that if goods come into the UK below £15, there's no import VAT. That creates a distortion of competition. So what the government has said is, well, we're going to remove that and we'll require VAT to be accounted for on all imports. And the way that that's going to happen is similar to the way the EU is going to do that. And we're going to talk about the e-commerce package later. And it's going to require the supplier to account for the VAT due on all goods up to £135. The reason £135 is there is because that's the customs duty threshold. So if you're a business which currently distance sells from Spain to the UK, that distance selling ceases to exist because the UK is no longer a member state. VAT will be due on the import of the goods, and this scheme will be applicable in relation to goods up to £135. So it's a change which the UK is introducing in a similar way to the way it's going to be changing for the EU. So if we now look at services, so services, there's no plans to change the place of supply rules in the UK for services. Now, the place of supply rules are there to determine in which country VAT is due. At the moment, the UK has to apply the EU rules, and that's to ensure there's no distortion of competition and also that there's no double or non-taxation. The UK's position is that they're not going to change them significantly because they don't want to become in conflict with the EU, and that's common with lots of other countries that trade closely with the EU. They've got similar rules, for example, Switzerland. The UK's change status to a third country does need to be considered. So you need to look at the rules and see whether there is any change in the place of supply. If there is, you need to think about how that is going to impact you. And essentially, you need to consider any liability to be registered in the UK on an ongoing basis. So if you are providing telecoms, broadcast and electronically supplied services, TBES, the way that that's accounted for at the moment is that the place of supply is where the customer is resident. So if they're resident in the UK VAT's due, but it can be accounted for under the mini one-stop shop. So if you've got customers all around the EU, you only have to submit one declaration in your own member state. Going forwards, you won't be able to use MOS for accounting for VAT in the UK because the UK won't be a member state, and instead you'd need to register for VAT in the UK in order to account for that VAT. So there are some simplifications which will no longer apply. So triangulation is often used simplification. It applies where there's three parties in three different member states with goods being dispatched directly from the first country to the last. So for example, you could have goods being sent from France to the UK, but being sold to a Spanish intermediary. So the movement of the goods is France, UK, but the invoicing flow is France, Spain, UK. So at the moment, the application of the triangulation simplification removes the requirement for the registration. So for the Spanish business to be registered for VAT in the UK, it can pass that obligation onto the UK business and remove the need to be registered. There is a need to meet reporting and invoicing obligations, but it removes the need to be registered. Now, it's an EU simplification, and because the UK is no longer going to be a member state, and goods moving from France to the UK are going to be an export from France and an import into the UK, that simplification is no longer going to be available. So if you're using that at the moment, you need to think about what the implications are. So, and a lot of this is going to come down to Incoterms when it's looking at imports and exports. So Incoterms are the trade terms which determine who has got the responsibility for certain actions, and deliver duty paid is the Incoterm where the main issue arises, because that means that the supplier has to account for has to deal with the import formalities. So if we look at when VAT registration is required, so as I mentioned, we've got these place of supply rules. They determine in which country the VAT is due. There's separate rules for goods and services, so you need to work out which place of supply rule impacts the type of supply that you're making. Once you've done that, that determines where the VAT's due. You then need to look at the liability to account rules, because that tells you who has the liability to account for the VAT in that country. So the default is it's the supplier, but that can shift to the customer in certain circumstances. So it's called the reverse charge. It applies widely for general rule B2B services, but it can also apply to other services. So the UK has got a reverse charge for services, but not for goods. So unlike Spain, which has got a reverse charge for both. So you need to look at who has the liability to account. If the supplier has got the liability to account, that's when VAT registration is required. So one issue that arises for businesses post-Brexit is fiscal representation. It's a requirement in the number of countries, including Spain. The UK doesn't normally require a fiscal representative to be appointed. HMRC, the UK tax authority, does have the ability to be able to require it, but they only do it in case of previous compliance issues. So if you do have to register in the UK, you shouldn't have to appoint a fiscal representative. Okay, so if we then look at how, we've looked at sales and we've looked at whether there's going to be a liability to be registered, we'll now look about incurring VAT in the UK post-Brexit. So as I've said, the place of supply rules are going to remain unchanged. So what that's going to mean is that if you incur UK VAT currently, you're likely to incur it in the future. So expenses such as hotels, meals, and some travel are all going to be liable to local UK VAT because the place of supply is the UK. B2B general services should continue to be free of VAT. So if you're most B2B services, place of supply is where the customer is established, that won't change just because the UK is leaving. But there are going to be new instances of where local VAT is going to be incurred. For example, imports. If you're the importer of record into the UK, there will be import VAT due. There is postponed accounting, but that's only available if you're registered. So you need to think about how you can recover that VAT. So there's a number of different recovery options. If you're registered, you can obviously get it back via the VAT return. If you're in a repayment position in the UK, generally you'll get the money back pretty quickly. Customs might decide that they want to do an audit, but if they do, it's generally carried out relatively quickly. And if you're going to be in a situation where you're receiving regular repayments, they'll generally pay that back very quickly once they understand that that's what the business model means. If you're not registered, there's the potential to make a claim to the UK tax authority. So at the moment, Spanish businesses can make a claim under the refund directive. So it's an electronic claim via the Spanish tax authorities. That's going to go because it's no longer, the UK is no longer a member state. So at the moment, there's a paper-based system in the UK, which has got a different deadline from the refund directive. But HMRC are trialing a new portal to allow non-paper claims because I think they recognise that there is, it's not a robust system to make paper claims in the current digital age. One point to remember is deductibility can be different from under the refund directive, and there is also the concept of reciprocity. So if your country doesn't allow a UK business to make a claim, even though there's a refund mechanism in place, for example, in Spain, the refund directive, the UK can then invoke reciprocity. So if you're incurring UK VAT, you just need to think about how you're going to recover it. If you're going to incur it, one thing to bear in mind is that you can only recover VAT that's been charged correctly. So if the suppliers charge VAT incorrectly, the correct method of recovery is to go back to the supplier. So if you're getting charged VAT, you should always question whether it's been charged properly, because often the easiest way is to go back to the supplier. Okay, so that's Brexit. So it is creating lots and lots of issues for businesses around the EU, especially in the UK. There is a lack of clarity about exactly what is going to happen, as we've talked about, but there is enough clarity to know what you need to do from a VAT point of view. So if you haven't already done so and you have it trade with the EU, UK, you need to review what's happening. So we'll move on to the e-commerce package. So the e-commerce package is part of the EU's modernising VAT for cross-border initiative. So they're recognising that the VAT rules that have been introduced were introduced many years ago, and they haven't really kept up to speed with the way that e-commerce has progressed. It's a very different world now in 2020 from when it was in 1993 when the single market was introduced. So it's their initiatives to try and make sure that tax is accounted for in the right place, and that there's as simple a mechanism as possible in order to be able to do so. So this is the e-commerce package is a number of different measures which are going to apply to cross-border trade B2C for goods and services. So the rules for intra-EU B2C goods are going to be changing from the 1st of July 2021. So at the moment, we've got the concept of distance selling. So if you sell goods from one member state, for example, Spain, to another, you account for Spanish VAT until you've exceeded the distance selling threshold in the other country. So larger businesses will have to register in multiple countries. Smaller businesses potentially only have to register in their own member state. The issue with that is that it can create distortion of competition, because where the goods are being consumed, so the member state where the customer is not necessarily getting that VAT. So the idea is that these current distance selling thresholds, which are between 35,000 or 100,000, they're going to be replaced with a single EU-wide threshold of 10,000 euros. So that's not per country, that's for the total EU sales. It's going to apply to EU sales of intra-EU goods and TBES services. So if you remember, TBES is telecoms, broadcast and electronically supplied services. So if you've got other services which come within the scope of these changes, there's no threshold. So you need to account for that in that other country straight away. The threshold doesn't apply to non-EU businesses. And there are other complications on how the threshold applies. But the reality is that it's designed to remove micro businesses from the requirement to account for VAT in every country. So most businesses that have got any level of cross-border B2C trade are going to be hit by these new rules. And what's going to happen with goods is that the place of supply is going to be where the transport ends once the threshold's met. So once you've done that 10,000 euros, if you sell to 26 other member states, you're going to have to account for VAT in every single member state, even if you're selling only minimal amounts to that individual country. If the total amount is over 10,000, you have to account for VAT wherever the goods go. The place of supply rules for the B2C services aren't changing themselves, but the mechanism on how you account for it is. So if we look at how this has progressed, the other issue that it's seeking to address, similar to the UK, is the low value consignment relief. So currently goods up to 22 euros can be free of VAT when they're imported into the EU. So that's created massive distortion of competition. So a Spanish business or a UK business selling goods to a local customer will have to charge them local VAT irrespective of the value of the goods, if those goods are liable to the standard rate of VAT. That's because the place of supply for local sales is where the goods are made available. But if you've got a business in the US, they can currently sell goods up to €22, which are free of VAT. So there's not a level playing field between that local business and that US business. So that's what this change is seeking to address, to make sure that there's a level playing field, so both are competing on an equal basis. And lots of countries around the world are starting to introduce measures such as this. So Switzerland, Norway, Australia, New Zealand, they're all recognizing that distortion of competition, because of the way that the internet has developed and the ability to easily trade cross-border and cross countries, means that the current rules, the existing rules, are no longer fit for purpose. So the consequence of all these changes is that there's going to be a need to account for that in many more countries. So to mitigate that, the current mini one-stop shop, which we mentioned earlier, for those TBES services, are changing, and it's going to become a more detailed one-stop shop. So they were originally planned to be brought into place on the 1st of January 2021, but it's been delayed due to COVID. So it's the new implementation date is the 1st of July 2021. The Commission wants to introduce it as soon as possible because they see there's a significant benefit to member states in doing so. They've estimated that there's an additional €7 billion of revenue for member states per annum. So they don't want to delay it any further. They've seen COVID as something which is unavoidable, but they want to make sure that they introduce it as soon as possible. There has been potential for further delay because some member states have said that they're not ready. So, for example, the Netherlands and Germany have both said that they've got issues in even meeting the revised date. The latest position that we've heard from the Commission is that if their member state isn't ready, effectively businesses in that country are going to be put at a competitive disadvantage. So if they don't use the one-stop shop, which allows you to submit a single return in your own member state to account for all this VAT due in different countries, the alternative is you have to register in every other member state. So they're really trying to put pressure onto member states to make sure that they are ready, and they've offered assistance to those countries to make sure that they are going to be able to meet this new revised deadline. So it's still unclear, but what is very clear is the Commission is really pushing hard to make sure that there's not going to be any more further delays. So there's 3 different versions of the one-stop shop. So there's going to be a union OS that's going to apply for intra-EU suppliers of goods by EU and non-EU suppliers, and also intra-EU B2C supplies of services by EU suppliers. And we'll look at how some of these work in a moment. There's also going to be the non-union OS. So that's going to be services provided by non-EU suppliers. So if you're an EU business, you won't use this one. And then also the import OS, which is going to be for imports into the EU of goods which are below €150. So as an EU business, there's potential for you to have to use more than one OS. So for example, if you've got goods that are situated in the EU, you're selling them cross-border B2C, you'd use the union OS. If you're then also sourcing those goods and they're being sent directly from the supplier outside the EU to a customer in the EU, there's a potential for you to have to use the import OS as well. So there's a number of different variations. Key thing to mention is it's not compulsory, so you don't have to use it, and you can continue to be registered for VAT in each of the member states in which the VAT's due, but you'd need to recognise that VAT is going to be due in a lot more member states than it was in the past, potentially. So you need to think about the relevant factors and then decide whether OS is the right answer or whether you want to remain or become registered in various countries. So we'll just have a quick look at how they work in practice. So this is the one-stop shop. So this is where we've got goods going from Spain, from Germany to France. So they were in a warehouse in Germany being sold by a Spanish business. So the goods are going to be shipped from Germany to France. So the place of supply is going to be where the final goods are delivered. So the place of supply is going to be in France. So that's where the VAT is going to be due. So the underlying supplier in Spain can account for the VAT due by submitting a one-stop shop return, which they'd submit to the Spanish tax authorities. They'd pay that VAT to the Spanish tax authorities as well. Spanish tax authorities would then transfer that return information and the payment via an EU data exchange to the French tax authorities, who would then receive the payment of the VAT due. If you can notice down in the bottom left-hand corner, we've got the shopping cart. So the VAT due would be at the rate that's prevalent in France. So that's a relatively straightforward way of being able to account for VAT, because if you've got customers in all member states, you can do that one return in Spain for all of those different countries. So that's OS. So that also, as I mentioned, applies to services as well. So if you're providing services, you can do that as well. The next one is the import OS. So this is where goods are going to be arriving from outside of the EU. So in this case, the origin of the goods, the underlying supplier, is based in the US, but this could equally be goods going from an EU business's supplier directly to the customer. So if you see at the top in red, we've got D2C. So this is direct to consumer. And the reason we've used D2C rather than B2C is because it recognizes that the sale is made directly from the supplier to the customer, and it's not being made through an intermediary like a platform. We'll talk in a moment about some rules changes which are going to apply to platforms, which mean that the VAT position can change. So in this case, the US supplier sends the goods directly to the customer in France. Because the goods are below 150 euros intrinsic value, place supplier is going to be France, and French VAT is going to be due. So the supplier, the underlying supplier, decides that it wants to use the import one-stop shop. It registers in one member state. It's got free choice in relation to how it does that. It decides it's going to register in Ireland. It has to appoint an intermediary because it's a non-EU business. There may be a requirement by the tax authority to put in place a guarantee, but essentially, in the same way as before, it would submit a single import one-stop shop return to the tax authorities where it's registered, who would then transfer the money to the tax authority where the VAT is due. And one point to bear in mind in this is it only applies where the intrinsic value of the goods is below 150 euros. The reason for that is because that's the threshold for customs duty. And on the shopping cart on the left-hand side, we've broken down how that actually applies in practice. So intrinsic value means the value less any taxes which are due, and also any shipping and insurance, as long as those amounts are shown separately on the invoice. So you can see the price here is 192. So on first glance, that would suggest that it's above the 150. So you couldn't use the import one-stop shop scheme. But if you break it down, it actually shows the intrinsic value of the goods is only 140. So it's eligible to use the scheme. So again, this is not compulsory, but you have got the option that you can use it. So just finally, with the e-commerce packages sales via platforms, so there's going to be significant changes where sales are being made on platforms such as Amazon. So what the EU is seeking to achieve is to get the tax for certain transactions from the platform rather than from the individual supplier. So that makes it much easier for them to control and monitor the situation. So the liability to account shifts to the platform in certain cases. So if there's sales of imported goods, 150 euros, that applies in all cases, and that's irrespective of whether it's an EU or a non-EU supplier. And also in relation to sales of EU goods, but that's only in respect of non-EU sellers, but irrespective of value. So if you're selling via platforms, you need to think about how that's going to work. If there is a sale of imported goods under 150, that liability to account is going to shift to the platform. So you need to make sure that you understand how it's going to work, who's got that liability to account. There are lots of other issues and nuances with regards to the e-commerce package, because it's in many respects it sounds like it's simple because it is a simplification, but there is lots of complexity. So if it's something that affects you, it's something that you do need to start thinking about now, because whilst it's not going to be introduced until July, there's lots of preparation that needs to be done in order to make sure that you're ready and your systems are ready in order to be able to deal with it. Okay, so the last section is in relation to the 4 quick fixes for VAT. So these were introduced earlier this year. So the 4 quick fixes are in relation to call-off stock, chain transactions, conditions for exempting EU movements of goods, and the evidence required to support that movement of goods. So the idea is that they're a short-term solution, which hence the name quick fixes, and they're there to create consistency or attempt to create consistency between member states, because it's recognized that in a lot of cases for these types of issues, there's different approaches taken by different member states. They're provisionally in place until the 1st of July 2022, when a new definitive VAT system is planned to be introduced, but COVID has changed lots of things and there's the potential for that to be delayed further. So if we just have a quick look at each one of these quick fixes. So we'll start with call-off stock. So call-off stock is where goods are shipped from one member state to another. And they're then held in a warehouse prior to being called off by the customer, as and when the customer requires those goods. So rather than you delivering them straight and selling them straight to the customer immediately, they're held for a period of time before the customer actually wants them. So the way the quick fix is going to work is that transfer of goods from one member state to another, where they're to be for the purposes of call-off stock, is not going to be a supply of goods for consideration. So the previous treatment was that some countries had introduced simplifications, which removed the requirement for the supplier of the goods to be registered, whereas others had said, well, no, there's no simplification. If you're a supplier of goods in the call-off situation, you need to be registered for VAT. So the introduction of this call-off stock quick fix is to provide consistency of treatment and remove the need for the supplier to have to register where they've got a call-off stock in another country. So there's a number of requirements need to be met. So they need to be sent where they're going to be sold to an existing person, sold to another taxable person based on an existing agreement. So you can't just move goods speculatively in the hope that you're going to sell them in the future. That's not call-off stock, that's consignment stock. The supplier can't have a business or fixed establishment in the member state of the destination, because if they have, they're going to have the necessary mechanism to deal with VAT differently. The recipient of the goods has to be registered for VAT in the member state of arrival, because they need to account for the VAT due, and the supplier has to know their details and also their VAT number at the time the goods are going to be dispatched. There's also a requirement to submit an EC sales list, which details that original movement of the goods and then also the subsequent sale. So EC sales lists have become more complicated as a consequence. But the good news in relation to this is that if previously you had to be registered, you can remove that need to be registered in relation to call-off stock, which is going to simplify things, and also remove compliance costs, albeit that it's replaced by some additional reporting in your own member state. So there are some issues. The idea of call off stock is that it's not for goods that are going to be there held on an indefinite basis. So if goods haven't been sold for 12 months, there's a deemed supply after that period. If they're then sent back to the member state of dispatch within 12 months, there's no supply. There is also the ability to substitute the customer. So you need to record it in your records, but there's no deemed supply and no need to be registered if there is a substitution within 12 months from that original customer. There are a few things that you need to be aware of. So it does apply to all call-off stock arrangements in all member states. So it's not optional. It has to apply. It changes the law in relation to whether there's a deemed movement of own goods. You can cancel those existing registrations that are in place if you are operating call-off stock. Some of the considerations you need to think about is if you meet any of those conditions, you fail to meet any of those conditions, you've got a deemed supply, which means that you're going to need to register in that other member state. You also need to make sure that you've got systems in place to manage changes in circumstances, such as that sale to a different customer. So you're going to need to be able to monitor carefully any changes, and also think about what happens with destruction, loss or theft of those goods when they're in the other country. Now, one of the issues that we've seen in practice is that some customers are saying to their suppliers they don't want the call-off stock quick fix to apply because they don't want to have to deal with the administration. They want the supplier to continue to be registered in their country, and that can create some practical difficulties where you're trying to retain a registration when the quick fix says that you can't do so. If we now move on to a couple of other changes, so chain transactions. So we talked about chain transactions earlier. This quick fix only applies where the intermediary party organises the transport. So at the moment, that would be the move-in delivery from A to B because the goods are being transported by B. The quick fix allows the move-in delivery to be shifted to B to C, and that can reduce and remove the compliance obligations for the intermediary party. So there's a number of conditions that need to be met, but it does potentially simplify and remove the need for the intermediary to be registered for VAT in the member state of delivery. So we're running short of time, so I won't provide any more detail except to make sure that you always, when you've got a transaction, make sure you understand where in the chain you sit and also what's going to happen to the goods, especially if you're not delivering them directly to your customer. So if we move on to the next quick fix, so this is the mandatory use of VAT numbers. So again, it applies when you've got a cross-border movement of goods from one member state to another. So in the past, differing member states had differing rules. So if we look at how this applies now, so the exemption in Article 138 for cross-border movement of goods can only apply in the future if these following conditions are met. So these are substantive conditions, so they have to be met. So the first one is that the recipient is a taxable person or non-taxable person acting as such in a member state other than the member state of dispatch. So basically they're a taxable person in another country. They're registered for VAT in a member state other than the member state of dispatch, and the VAT number has been communicated to the supplier. So that's the change where you've got to give your customers got to give you a VAT number in order for the exemption to apply. Now, this was already in Spanish legislation, but it wasn't everywhere, and there was lots of ECJ cases about it. So that has to be communicated. It doesn't have to be a VAT number from the member state where the goods are going to, but it has to be a different number from the member state of dispatch. And then the final condition is that you have to complete an EC sales list in order for the exemption to apply. So again, that didn't apply previously. So there are clear advantages because there is clarity. There's an it actually is now in the VAT directive to try and remove that ambiguity, but there are some issues about, well, you need to make sure that you get the VAT number every time. You need to make sure you check it. VEES allows that to be checked. Not all customers will be on VEES. So, for example, Italian customers aren't automatically put onto VEES. So, but that's the substantive condition. So you can't exempt if you don't have the VAT number and it isn't valid. You also need to make sure that you're submitting that EC sales list on time. If we now move finally on to the last quick fix, so this is the evidence required. So if you move goods from one member state to another, you don't need to charge VAT, but you don't. You can only do that if you've got the required evidence. And what this quick fix is trying to do is harmonise and simplifying the rules for obtaining evidence. So it's putting in a rebuttable presumption that the exemption can apply if you meet the conditions set out by the quick fix. So we've set out there what the requirements are. So the supplier indicates the goods have been sent and is in possession of 2 items of non-contradictory evidence issued by 2 different and independent parties, or the supplier has a written statement from the acquirer stating the goods have moved, and also 2 items of evidence as set out above. Now, the reality is it provides clarity, but the difficulty is that those items of evidence in lots of situations are going to be difficult in order to obtain, especially if they need to be dependent upon how you move the goods. Getting evidence from 2 partners might be difficult because you may only have one, or you may be doing it all yourself. So there are difficulties in order to make sure that you can avail yourself of the quick fix. Okay, so we are unfortunately running out of time. We will very briefly just talk about how we can help you. So we've got a lot of experience in optimizing supply chains from a VAT perspective, and we can solve your VAT compliance issues. So Sovos Accordance is effectively a one-stop shop for all of your VAT needs. So we can provide the initial consulting to help you understand what your supply chain means from a VAT point of view, what your obligations are. If you then have to register in a country, we can then help you to register. We'll then deal with your ongoing compliance. We can then also help with your any other obligations. So, for example, real-time reporting is being introduced in lots of countries. We can help you to ensure that you fulfill that. And in terms of Brexit, we're working with lots and lots of different businesses to help them to understand the impact of Brexit and then what they need to do. And so we've got some supply chain reviews for EU businesses trading into the UK. And then we've also got the interaction of Brexit and us, because it does create a number of difficulties for businesses. So that's Q&A time. Unfortunately, we've only got a very short amount of time left, but I note that at the moment there's no questions in the Q&A section. So if you do have any questions, if you'd just like to quickly ask them, then we can deal with them. If you don't have time to do that now, we'd be more than happy to deal with your questions by sending us an email at the email address which is now on the screen, so marketing@accordancevat.com. So I think that's probably, there's no questions at the moment, but as I said, if you'd like to get in touch with us, and then I'll pass you back to Hannah to conclude the session.
Brilliant, thank you much. Andy, I think I speak on behalf of all of us when I say that was really, really, really useful, really clearly put, and really, really informative. So thank you very much for sharing your expertise with us. And I'd just like to remind everyone again that you will be sent the presentation so you can use that and consult that again at a later point. Yeah, please do get in touch with Accordance VAT if you want to find out more about any of their services using the email address on the screen, and also have a look at the event section of the Spanish Chamber of Commerce website too, or make sure you're signed up to our newsletter to find out more about the other webinars and online things that we're carrying out this month and next month. But yeah, thank you very much again, Andy, and the team at Sovos Accordance. And yeah, thank you everyone for joining us. Goodbye.